Today, we're going to look at dividends and income-focused investing. Now, that's a really important part of retirement funding that some people overlook because they just focus on stock prices. So let's start with the core of your income strategy, dividend-focused ETFs. Now, this first one is pretty basic. This is the Schwab U.S. Dividend Equity ETF, ticker SCHD. It tracks the Dow Jones U.S. Dividend 100 index, and that's companies with sustainable dividends, which means you can expect steady income. Its yield is over 3% right now, so not bad at all, and without a lot of volatility. Now, here's an ETF from almost the opposite end of the spectrum, HYG. It's high yield corporate bonds. And this one lives up to its name with a yield of 5.88%, but everything comes with a cost, right? And the cost here is higher risk. High yield bonds are closer to stocks when it comes to risk levels. It doesn't mean you shouldn't own them, but use some caution and don't just overload your portfolio with these because you want the yield. I had a client once who came in and said she didn't want junk bonds, which these are high yield junk bonds, just different names for the same thing. But it turned out she had not one, but two high yield bond funds, what that another advisor had put in there. So be aware of what you own and why. This chart shows the spread between high yield bonds, corporate bonds, and treasuries. Now, the high yield bonds are issued by companies that are rated below investment grade, and investors demand a higher yield because they're taking on a greater risk of default. Now, you can see this risk-reward dynamic here compared to other types of bonds. Okay, next, let's look at international dividends. ETFs like this iShares International Dividend Fund, ticker IDV, can also present opportunities for retirement investors. Fun fact, a lot of international markets have higher dividend yields compared to U.S. stocks. But trade-off here, right? Everything comes with a cost. You need to consider currency risk. Sector rotation. During volatile markets, rotating into high-income sectors like utilities or REITs can help stabilize your return. REITs, for example, real estate investment trusts, have both steady dividends and exposure to real assets, so that is frequently a hedge against inflation. Here you can see the yields from Vanguard's VNQ REIT ETF. And now the utility sector, XLU. So you see, these can offer investors some dependable yields as part of an income strategy. Now, if you like more of a DIY approach, consider tracking ex-dividend dates for potential short-term opportunities or as a good entry point. Stocks and ETFs typically see minor price dips on these dates, and that gives you a chance to trade tactically or just enter into a new investment that you're planning to hold for longer. Here's how Apple's price moved lower around its ex-dividend date. And these dips can be small, but meaningful, and they're expected. Now, some of that movement can be attributed to normal market movements or just noise. But typically, the ex-dividend date presents an opportunity to buy on the dip. So that's a look at how to incorporate dividends and income strategy for long-term cash flow. Remember, your goals and risk tolerance should always determine your investment strategy. It's not a guessing game, okay? All right, thanks for watching. Don't forget to like and subscribe to help me bring these investment and retirement planning ideas to more people.